superstars. This is Professor Don Bush. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. So I'm glad you're here, folks. This is the place to learn. All right, so what we're studying is we're studying adjusting entries. And this lesson is meant for people that are just beginning their education in accounting, maybe their third or fourth week of school, and they're probably in the third chapter of their beginning accounting textbook. And the third chapter is a hard chapter in accounting. Everybody struggles with it, and if you're struggling with it, you're normal. And I struggled with it, and all my students always struggle with it, so it's normal. So don't worry about it. And if you're determined to learn accounting, you'll get it. It's not that hard. It's just a little confusing at first. So here's what we got going. We've got a very simple adjusting entry to do today. So here we are. We have when we get to it, construction, and they just finished a construction project, and it happened at the very end of the year, and the bookkeeper did not have time to send an invoice to the customer. So it never got entered into the books. So here's what it is. It was just a construction contract for $50, and I kept the amount little just so you can focus on the concepts and not worry about the numbers. So it's a $50 contract that just didn't get entered into the books. So here's what's happening, guys, is that when we get to construction, did their work, they finished the job, they did everything it took to get the job done, and the customer owes them some money. All right, so we're going to record it in the current year, even though it's at the very end of the year. So here's the adjusting entry that the accountant would do. There it is. So the accountant would debit accounts receivable for $50 and credit revenue for $50. And what this will do, this will get the books up to date, showing that that they completed a job and they're owed money. And of course, you know, we're using little numbers, and in real life, maybe it would be a contract for $500,000 or something. So it would probably be something very important, very significant. Now, coming down here, all I'm doing here is just showing you how this affects the books, all right? Just how it affects the books and how it all works out to help you visualize what's going on. So here's what it is that accounts receivable already has a balance of $100 in it already. And that does not include the $50 up here that the accountant entered in. But it has a $100 balance. So what we're going to do is we're going to take that accounts receivable, and it's being debited for $50. So let's put that debit of $50 right down there, okay? So all we're going to do is we're just going to proceed across the page here. So accounts receivable is 100, debit, and we have an adjustment of a debit. So that means that we have a debit of 150. In other words, a debit of 100 plus a debit of 50 is a debit of 150, all right? All right, and then lastly, we got to decide, well, what financial statement does it go on? Well, what financial statement does it go on? On the income statement, there are only two things that go on the income statement. That's it, two things. Expenses and revenue. That's it. Nothing else goes on the income statement. Now, accounts receivable is not an expense. Accounts receivable is when people owe you money. All right. So it's considered to be an asset. All right. It's an asset. So where do assets go? Well, assets go on the balance sheet, and I hope you remember from probably your first week of accounting class that there are three things on the balance sheet. There are assets, liabilities, and equity. All right, so accounts receivable is going to go to the balance sheet. Now, the next question is, well, does it go there as a debit or a credit? Because you got two columns there. What happens? Well, here on the adjusted trial balance, it's a debit of 150, so it's going to go on the balance sheet as a debit of 150. There you go. And you might say, well, don't debits and credits need to balance and all that stuff? And they do. They always have to balance. But we're just looking at a little teeny piece of this worksheet. And by the way, a long time ago, 50 years ago or whatever, all accounting was done by hand, and it was done like this. And the nice thing about it was you could see what was going on. You could visualize it a little bit more. All right, going on. Now, revenue here has a balance of $300. Now, that $300 does not include that 50 here. In other words, throughout the year, they had earned quite a bit of revenue, and it amounted to $300. All right, so what we're doing is we're adding another 50 to it. So here, revenue is a credit for 50, so I'll put it here as a credit. There we go. So in the unadjusted trial balance, we have a credit of 300, and the adjustments is a credit of 50. So that's a credit of 350. All right. So say it all another way. Credit of 300 plus a credit of 50 is a bigger credit of 350. There you go. And then finally, we have to decide, well, does it go on the income statement or does it go on the balance sheet? Well, here's what it is. There's only two things that go on the income statement. Expenses and revenues. That's it. Expenses and revenues. Well, revenue is going to go on the income statement. And you might say, well, does it go as a debit or a credit? Well, it's sitting here in the unadjusted trial balance as a credit, so we'll put it here on the income statement as a credit, all right? And you might say, well, don't debits and credits have to balance and all that? And it's true, they do, but this is just a little teeny picture of what's going on. So things are going to balance. All right, so there's your very first introduction to how this all works. So if this helped you out, hit that like button, hit the subscribe button. That way you can see future videos, because I'll be making a lot more of these. And let me know in the comments what is giving you a hard time in accounting, and I'll help you out. All right, so until next time, over and out.